Today I am at McNear's Beach Park, and I was here probably a little over a month ago, but last time I never walked down the beach with you guys, so that's what I'm going to do today. And we are going to talk about all different types of things related to the job market and the economy, because I really feel like it's all eyes on the job market right now. That should be the biggest concern at the top of everybody's mind, right along with inflation, which we will talk about as well. Even the Fed is paying attention to it, so much so that they're using it as the excuse to start lowering interest rates again. So we need to look at it because this one chart shows us that the US labor market is running on fumes right now. According to economist Dario Perkins with TS Lombard, there's a chart that we need to look at called the 6-month rate of change in core jobs, which he defines as the US payrolls figure excluding government and healthcare, which has now slowed down to only 0.02%, which barely leaves it in the positive category. When we look at this chart, going all the way back to 1961 through present day, we can see that job growth is almost negative when you take out government jobs and when you take out healthcare jobs. And apparently, going all the way back to 1960, there has never been a time like now where the job growth has just completely come to a halt. We have seen it go negative in the past. We've seen that happen quite a few times, but as it goes negative, it bounces back. That's what all of those dips and spikes are in the past. But looking at present day, over the past several months, it has just kind of been sitting around flat territory, which is something we haven't really experienced before here in the US. Usually a slowdown in hiring is followed by rising layoffs and a recession. And in the past, whenever job growth comes to a complete halt like now, it typically signals that we are in a recession, which further confirms what I've been saying here on the channel for the past 2 years, that we have been in a recession, but only just now the official data is starting to catch up to it, because they've been able to do a lot of things to kind of hide the fact that we are in this recession. Whether intentional or not, it doesn't really matter. It's really just more about how the data is calculated and presented today versus how it was calculated and presented 30, 40 years ago. Another thing that this chart shows us is just how dependent the US economy, particularly the job market, has been on the growth of healthcare jobs, because healthcare and social assistance jobs accounted for a whopping 87.3% of total private payroll growth in 2025. And this is why I keep telling people every time we get the new jobs report, unless you are looking for a hospitality job or a job in healthcare, you're essentially out of luck right now. There's not a whole lot of opportunities out there to be had, unfortunately. And you know, the most ridiculous part of this story is that I'm with the economists on this, talking about how this chart is a big warning sign for the US economy. But he says, well, this is justification of why the Fed does need to lower interest rates because the job market is in trouble. Well, let's not forget that the Fed has a dual mandate, and the other half of the mandate is they need to make sure inflation remains under control, which we'll talk about a little bit later in this video. We have some new data that shows that it's continuing to go up. Another thing that he points out is that the S&P 500 is currently trading at 27 times earnings, which is historically high. So investors might be more sensitive than usual to upcoming economic data. Well, one thing that I learned recently that I want to share with you guys is take a look at this chart here. This shows you a bunch of different commodities, including currency, Bitcoin, treasuries, as well as some of the stock market indexes of how much value these things have lost or gained, or what their price is in gold. And we all know that gold continues to hit record prices in this economy because people know that inflation has not been squashed and is still a major problem. And what do we see here? All of the currencies, all the major currencies are down like 50% or more compared to 5 years ago when priced in gold, okay? Bitcoin, however, is actually doing fantastic, almost 500% in the past 5 years when priced in gold. However, it is down 11.5% over the past month when priced in gold. But take a look at these stock market indexes. Look at the Dow. Over the past 5 years, it's down 11.6% when priced in gold. The the S&P 500 is only up a measly 5.1% when priced in gold. And you can see some of the other indexes here below that are negative quite substantially, negative 26%, negative 15% when priced in gold. And we have to price things in gold because even though people don't use gold to buy everyday items, gold is the only real money civilization has ever had, okay? And the price of gold only reflects how much value our currency has lost. So when you price these type of things in gold, like the stock market is the perfect example, showing that the S&P 500 is only up 5.1% over the past 5 years, but it keeps hitting new record highs when priced in dollars. That should be a huge warning sign for everybody, especially if you have a lot of money tied up into the stock market, because it might make you feel rich, but this proves to you that people are being robbed by inflation right now. And the saddest part is most of these gains in the stock market, if not all of them at this point, have been fueled pretty much just by the wealthy, people who continue to pour money into these investments because they're feeling like there's nowhere else to turn. And I don't blame them because there's not a whole lot of good options out there right now. Real estate, that's a tough one. Values keep coming down. It's a terrible time to be a landlord as rent prices are also falling, even though the expenses to own a home have been rising. Owning a business is tough right now, especially if you're highly reliant on getting new customers and getting people to spend more money than last time. Good luck with that when people are broke. The only real thing left, in my opinion, is gold and silver and Bitcoin. Even businesses like McDonald's and Dollar General that typically cater to the lower income households have said and observed recently that spending from lower income customers has started to drop off. And that's why we've seen so much trouble with these companies. Companies that used to be bulletproof, essentially, during a recession and during tough times are no longer. Because these companies also cannot hide from inflation. They all have increased costs that they have to pass along to customers, and the customers simply can't afford it these days. And I just have to hammer this point home, guys, because the other day I made a video. I was talking about how parents have been telling their college-age kids that they shouldn't be going to college. They should be maybe looking into the trades to get a better job and have a better career opportunity. Take a look at this comment from one of my viewers that kind of hits that point home. He says, "I'm a CNC machinist in, I'm guessing, Ontario. There is so much work in machining. I'm 63 and still working. I could probably work until I'm 70. Bills always get paid. You don't make a lot of money, but there is always work around." Now, ideally, you want to get into a trade where you can make a decent amount of money. I don't know what he makes. He didn't disclose his income here. But the point is he's not out of a job, right? So you want to look at different types of trades that you can get into that AI cannot easily replace: being a plumber, being an electrician, being a roofer, getting into construction, stuff that is not easily done by a computer. Because on the flip side, when you are in the tech industry, for example, one of my viewers, Sylvia, was one of the recent people who was laid off from Intel. You know, Intel and Microsoft this year have been laying off more people than ever, and she was one of them. Last year, Intel laid off over 24,000 people, and she was one of them. And fast forward today, 1 year later, she is still looking for a job. And she didn't do anything wrong. She went to school, she got a degree, she got a really good job until they don't need her anymore. And unfortunately, this is where it ends up. And I would keep going, but we are at a dead end. We'll turn around and go back the other way. But the reality is this job market is showing no signs of recovery anytime soon. As of August, there are about 7.23 million job openings, according to the BLS. And the hiring rate is now at the lowest point that we've seen since June of 2024. And also, the amount of people who are voluntarily quitting and leaving their jobs right now is at the lowest level of the year, which is not really a surprise. The U.S. hiring rate is only at 3.2% as of August, which is pretty much the levels that we saw during the Great Recession. That doesn't give you a whole lot of confidence that if you need to find a new job right now, after getting laid off from another one that you're going to be able to just go out there and get hired. And that's why I think it's all eyes on the job market right now. This has to be the number one concern that people are worried about, because let's face it, without a job, people can't pay any of their bills. Even with the job, people are having a hard time paying their bills. Imagine how it's going to be if enough people lose a job. There's going to be so many delinquencies, so many foreclosures, so many car repossessions, so many bankruptcy filings. It's not even going to be funny. That's why we keep seeing the consumer sentiment numbers slip. We already talked about the University of Michigan numbers last week, but this week, according to the Consumer Confidence Index from the Conference Board, their numbers are showing that consumer confidence dropped to 94.2 in September from a revised 97.8 in August, which is the lowest level that we've seen since April of 2025. The prediction was that it was going to be at 96, and it ended up being at 94.2. And consumers' assessment of labor market conditions also fell for the 9th straight month. So ever since the beginning of the year, people's outlook and optimism about the job market has been continuing to deteriorate. What does that tell you about where we're at right now? Now, some of the economists think that if we pay attention to consumer spending, that's what we have to look at to kind of give us a clue of where things are going for the rest of the year and into 2026, which I think is kind of a joke, and I will explain why here in a second. But take a look at this. The MasterCard Economics Institute forecasts a 3.6% increase in spending for the period between November 1st and December 24th, which is down from a 4.1% gain last year. But it's still an increase. It's not the same level of increase as last year. Last year was 4.1. This year they're predicting 3.6%, but they're definitely not predicting a pullback where people actually spend less during the holiday shopping season than they spent last year. And they say that even with slowing job growth, the labor market continues to be supportive for now, and the fact that aggregate wage growth is holding up supports overall spending. Economists are going to be tracking whether or not consumers are spending based on discounts and promotions, and they're expecting online spending to increase 7.9% during the holiday period. They also believe that a lot of people are going to turn to buying gift cards for Christmas this year rather than actual physical goods due to the impact that tariffs are going to be having on so many of the imported things that people would typically buy as gifts, including Christmas trees. And right now the CPI is at 2.9%, and they're forecasting it to be 3.4% by the end of the year. And they're talking about how consumers are a formidable force in the economy and how their spending drives 2/3 of U.S. gross domestic product, also known as GDP. And that's one of the reasons why they say that things are looking so good right now, is because the GDP figures have been strong for the first half of the year. Check out the deer. It's like a buck. So the reason why this whole argument that consumer spending is going to be the key element to watch to see if people are essentially broke or not and how strong the economy is ridiculous, because they just told us that inflation predictions, particularly the CPI, is supposed to be at 3.4% by the end of the year. It's at 2.9% right now, okay? And the latest GDP reading that we had was 3.8% up from last year. That's pretty much in line with these inflation numbers. So how can you sit there and tell everybody that the economy is running strong because GDP is at 3.8% up from a year ago when people have to spend that money? It's not optional, right? People need to spend that additional 4% in order to live, in order to buy the things that people typically buy. If you want to buy it, that is the price. It's not negotiable. You can't walk into Walmart and take an item that used to be $25 that now costs $40 and say, hey, I'll give you $30 for it. That doesn't work. You're not buying a used car. There's no negotiation. You either buy it or you don't. And something that we've known for a while is that the top 10% of all wealthiest households in this country have been accounting for more than 50% of the spending, which includes 50% of the GDP. Because if the GDP numbers are fueled by 70% of consumer spending and half of the consumer spending is coming from just the top 10% of households, well, they are essentially driving this economy right now. Meanwhile, you have middle income and lower income households struggling more and more with debt. In fact, delinquent home equity loans are at the highest level since 2015. Delinquencies on student loans of 90 days or more are at the highest level on record, over 13% right now. Not to mention the credit card and auto loan delinquencies as well. All while in August, we only had 22,000 jobs created after the massive revision, and 911,000 fewer jobs added between March 2024 and March of 2025. So essentially over the past year and a half, probably much longer than that, we have been severely lied to about the data. And somebody mentioned a comment about this and I answered them, but essentially they said, it's not that they're lying to us, Michael. You know, they give us the data based on their projections and then they revise it later. But even Jerome Powell said in his recent speech, go watch what he said, and he said something along the lines of, well, these jobs numbers typically come in hot, essentially meaning that they overestimate how many jobs have been created intentionally, only to be revised down later, which is why pretty much every single month there is a downward revision in jobs. But in the meantime, it makes the stock market go up. People invest their money based on these fake jobs numbers, and it gives businesses false confidence in hiring people. And it's all based on a weaker and faker economy. We're supposed to get a new employment report on Friday this week, which is predicted to show only 50,000 new jobs being created. We'll see what happens when we get that report. There's also this looming government shutdown, but we all know how that goes. They pretty much wait to the last minute, then they reach some kind of a deal, and then they keep it open. It's like not even worth talking about anymore. And even if they do shut down, it probably wouldn't be for more than a week. But the reason why all of this matters, and something else that we all have to take a look at and remember, is inflation, which I'm sure everybody's well aware of just by going and buying their everyday items and seeing the cost of life. The PCE index, which is the Fed's preferred gauge of inflation, rose 0.3% in August, okay? And the 12-month rate of inflation rose to 2.7%, leaving it almost close to 3%, much closer than the 2% target that the Fed claims that they're aiming for. So think about it. Month over month, the PCE index went up 0.3%, and core inflation is sitting at 2.9%, essentially 3%, and this is all happening while the Fed has just started their interest rate cutting cycle. Think about what that means for you. And even if their rate cuts do impact the job market in a positive way and inspire companies to start hiring more people, possibly even give some people a raise, how do you think that's going to really help anybody when inflation is continuing to basically run away? I showed you that chart earlier about US currencies and foreign currencies priced in gold, as well as the stock market indexes priced in gold. That's the true measure of inflation right there. And that stuff is all losing tremendous amounts of value when you price it in gold. And you're telling me that lowering interest rates in a time like this is going to help anybody? This is just going to make inflation even worse, which means gold and silver prices, for that matter, are going to continue going up, guys. Some people think that it's too late to own gold now that gold is continuing to break records and is very close to a $4,000 per ounce. But the reality is, it's probably just going to continue going up, because until inflation is under control, why on earth are we going to see a situation where gold prices stop going up? Until there's confidence that inflation has been squashed, why on earth would gold prices go down? There's no reason for it to. And the Fed just claims that, well, we can start lowering interest rates because of the job market, because inflation and price increases haven't been going up as much as expected. So they're basically saying that, yeah, we know inflation's a problem, we know it's bad, but it's not as bad as we thought it was going to be. So look over here and we'll try and solve this other problem. In the meantime, this other one's getting worse. And that's pretty much what they're doing. And I just have to wonder if inflation starts ticking up more notably, right? Like say the PCE goes back up to close to 4%, right? Is that going to be enough for the Fed to completely throw out the window their entire rate cutting cycle and go back to actually hiking interest rates? My guess is no, because the Fed has been politicized. But you never know. That would be the true test, I think, to see if they can actually throw out their rate cutting cycle in favor of raising interest rates because it's necessary to prevent everybody from going completely broke overnight. So let me know if you guys think that these new rate cuts are going to actually fix the job market, if magically we're going to see all of these jobs start coming back, especially since 87% of the job growth has been due to healthcare alone in the private sector, and basically the rest of it is all government jobs. Does that mean everything else in the economy is going to come roaring back to life with these rate cuts? Let me know what you guys think. And if you enjoyed this video, make sure you subscribe to the channel. And if you don't want to wait for my next video to come out, check out this one on the screen right over here, and I'll see you in the next one.